All right, so we're going to go ahead and work through module 3. This first one, I went ahead and put problem 1 and 2 together. Payback is really where you're just saying it cost us a certain amount of money. How long will it take for me to get that money back? Right. And so when you're doing payback, there is no time value of money, right? It's simply the as if there was no discount. Um, so right, you see like you would accept a project if the payback is less than some specified number of years. This would be, a boss saying, look, I'll give you the money, but I need to have it back in 5 years, or whatever. So there's that one. And then the other one, I just kind of show you how you work through how long it actually takes. So in this particular example, initially you pay 50,000, 20,000 comes out that first year. So there's still 30,000 left to pay off. 15,000 comes out in the second year. Right. And so that would leave 15,000. And so if you're going to get 20,000 in that third year, you would just say, okay, 15,000 divided by the 20,000 remaining. The 50,000 that you have remaining divided by the 20,000, you get the year. I'm sorry, let me clarify. And so total is 2.75 years. Okay. As far as the disadvantages, already said, the problem is it does not incorporate the time value of money. So this one's worded a little strangely because it says which one is a disadvantage, except. So, but yeah, so the problem with payback is there's not a time value of money, but it is an easy calculation, right? And sometimes people will like easy calculations. Okay, this one is a long one. So I have the problem here and then the solution set on the other one. So feel free to pause as you need, but we're looking at 3 different projects. If you notice there, project A, B, and C sub 0, that's the initial cost to start the project. And then you see how your cash flows work. Project A, you get a lot of money back quickly. Project B, you do not get money back quickly, but you get a lot of money later on in the future. And then project C, you notice it builds up and then it trails off again, right? And they all have their individual costs as well. And then it works through what is the payback, what if the cutoff is this period or that period, what do you use? Now, what if we were not doing payback, but trying to calculate the net present value, right, using a particular discount rate? The things there at the N, E, and then the F1, F2. Just to understand that these are some of those problems, right? If a firm uses a single cutoff period, it's likely to accept many short-lived projects. Yes, because if I say, hey, it's got to pay off in 3 years, I'm only going to get projects less than 3 years, right? And so you'll start getting a lot of short-term projects, which sometimes some companies really like. They feel that it makes them, it pushes people to work a lot harder over these short periods for these projects. So, and then as far as the F1, F2, if you discount a payback rule, will it accept any negative NPV projects? And then would it turn down any positive NPV projects? So you would never want to take negative NPV, right? You're destroying value if it's a negative net present value. And so, but would you possibly turn down some positive projects? Yes, you can. So, here's the answers. Just understand, as far as the, like where it says F, it'll accept no negative NPV projects, but you would turn down some positive ones, because it may take too long, because you still have like a time limit. The manager is only going to be here for 4 years, so he's not going to approve projects that take longer, or what have you. So, and this is a discussion about the internal rate of return, and I don't have a ready-made picture, so I'm going to draw one quickly here. So okay. And so if this is like the NPV, and this right here, right, would be the rate of return. The highest NPV any project will have is going to be when there's a zero discount rate, right? So we would start up here somewhere, and then the project, will then just follow straight down and reach here. And then this would be the IRR of this project. And then I might have a second project that may look something like this. And it'll have its own IRR. Right. And this is where we'll have those questions about which one do you pick? If the interest rates are low, you would pick this project because it's got a higher NPV. If interest rates are high, you take this project because its NPV is higher, right? And the IRR is that interest rate where the net present value equals zero. I know my lines aren't very straight. I don't. You're drawing with a mouse, so I'm sorry about that. But yeah, so just to understand, that's what we're talking about with IRR. It's what is the interest rate that makes that particular cash flow give you a net present value equal to zero. Okay. Oh, sorry, let me erase that annotation. Okay, sorry about that. Okay. And so as far as these reasons, I just want to let you understand multiple IRRs allow the company to choose the best one. That's not true. What multiple IRRs mean is that there's a lot of changes to your cash flow. So normally we talk about we pay, at C equals zero, C sub zero, or at time T sub zero, we're going to make some payment. And so it's going to be a negative cash flow. We pay it out, and then we get positive cash flows in the future. Well, if your project goes negative to positive to negative, then there's going to be two different IRRs that would solve that, right? It's a quadratic equation at that point. If it goes negative, positive, then there's three IRRs. So multiple IRRs can occur. It just normally means you have a complex payment stream, right? But it's not like, oh, this one is a good, this one's a better one, so let me use that one, right? But yeah. Okay, and if you notice here on number 8, we're just calculating what the net present value of these cash flows will be, right? They're going to be the same payment of 7,750 initially, but we're discounting those two future cash flows at higher rates, right? And if you're discounting it, at 100% discount, it actually ends up being an NPV of zero. So that's where your IRR is, right? Oh, that's what B is, right? It says the IRR is equal to that 100% because that's where NPV is equal to zero. So the higher your interest rate, the lower your NPV, and that's why we get that downward sloping line, right? So yeah. Here, problem 9, again, you see these cash flows. It's a negative cash flow, then it's a positive cash flow, and then it's a negative cash flow, right? So they tell us that the internal rate of return is 11.15%. The opportunity cost of capital is 10%. They ask us, okay, what is the net present value of the project? Well, the opportunity cost of capital is 10%. That's what we use as our discount rate. So would you accept this offer? Well, the rate of return, if you notice the NPV that we get is negative. You never take a negative NPV project, because negative NPVs are destroying corporate value, right? This isn't, oh, we'll lose money for a while and we'll make it back. We've already calculated that. That's why it's the net present value. We've already put all that together. It still loses money, right? So yeah, you should not take that. Again, this is a comparison between two projects. They cost the same amount of money, right? And each of them will return a fixed amount of money, one of them over 3 years and the other one over 4 years, right? And so the question is, which one is better, right? Which one should you use? And of course, the next slide, no, I'm sorry. Okay, I thought it had a little more. But no, as you're okay, I see down there at the bottom. Okay. But as you're going through with these projects, what you are wanting to do is understand, like, okay, well, at higher interest rates, these types of projects look better. At lower interest rates, this one looks better, right? And so when you're looking at projects, it's not as simple as the NPV is higher. You also have to think about what your interest rates will look like as you take on this new project. Okay, this is another project comparison, right? Their cash flows are listed up there. We assume they're mutually exclusive. We have our cost of capital is 11%, so that's how we'll discount it, right? And then as far as calculate the profitability index, this is just saying, okay, how much do I make back? What's the net present value of this project, right? Divided by the investment, right? And so once you get that, that will give you some positive number, right? Because we're only doing positive net present value projects, right? But that profitability index, this lets you know what that returning cash flow looks like compared to what you pay out. And when I say returning cash flow, the net present value, right, of that cash flow. So you can evaluate them together. All right, so moving on to chapter 6, we have someone that's going to receive $110,000 in 1 year, right? And he's going to discount that back at 9%. And they're asking us to calculate the present value of his payment using a real cash flow and a real discount rate. Okay, so the real rate, right? Let me grab my little annotation here. So this was a equation that Irv Fisher, IRV FISHER, he got a Nobel Prize in economics like back in the 50s. If you look him up, I think he has an interesting mustache. Okay, 1 plus the real equals. But he came up with this relationship. Okay, so if you can read that, 1 plus the inflation rate times 1 plus the real is equal to 1 plus the nominal, right? And so the nominal is at 9%, right? It's the very top. And then it says that the inflation rate is 5%, right? And so if you look at the equation there in the left, right, you see R equals, that's 1 plus real. So that's the real equals. It's the inflation, 1 plus 0.09. Here, I will grab a pen. Okay. So this was 1 plus I, 1 plus R, and 1 plus N. right? And we're just rearranging the terms to get us our rate. And so if you see over here, let's see, change colors. So this 1 plus the nominal rate here is equal to this one. And then 1 plus the inflation, right? They're on the same side, so I have to divide by it. That's why there's a divide line there. And that's this one, right? And it was 1 plus here, so I've got to subtract 1 off. So that's how we come up with what the real rate is, and then we're going to discount it at that real rate. All right, so here's probably looks a little familiar to some of your accounting class, but you see there's an accounts receivable, inventory, and accounts payable. And we're just looking at how this working capital has changed, right? And so initially there's no accounts receivable because we haven't sold anything. So we sold nothing on credit, but we did build up inventory. And we had accounts payable because we owed our suppliers, right? And then those numbers change over time. We have credit terms, both what we receive and what we pay. Inventory changes based on our sales, right? We're going to match inventory, those types of things. So, and then, it's just calculating the net working capital and then what the cash flows would be associated with that. Right. So net working capital initially was 53,000. Right, because we have inventory minus our accounts payable, right? And so since we've created that, we paid something, right? We had to pay for all that inventory to be made, right? And so that's what that cash flow is, right? And then you see the next year it grows, right? And the amount it grows is how much more I have to pay. And then it grows again and I have to pay more. And then as net working capital shrinks, that shows up as a positive cash flow because I'm liquidating that inventory, or I'm liquidating those accounts receivable, they're being paid off. While at the same time, I do have to pay back my payables. Okay. So this is a little bit about depreciation. Again, this is a lot of the sort of accounting type of stuff, but how to make the decisions, because we're already talking about projects and we want to talk about things like depreciation. And so for depreciation, it's a non-cash deduction. It does influence our cash flows. We add back depreciation and then subtract our taxes. We add back the depreciation because it wasn't a cash consequence, but we do take off our taxes, and depreciation definitely sheltered some of our income from taxes, right? So there is a cash flow impact, even though it's not a cash deduction. Okay, and then the life of an asset, that's how we depreciate it. We'll say, oh, this one lasts for 7 years, 10 years, 30 years, and we have an appropriate depreciation table we use. And then again, there's a work through on an example of that type of depreciation. So just to understand, when we're doing these types of projects, sometimes you will have depreciation that we will calculate in as we calculate our cash flows, right? So we'll say we expect sales to be this, but then once we run through everything and look at what the actual cash flow to the company will be from our project, that's what we're going to calculate net present value on. That's why we're going over this type of refresher. And this is just an example using a couple of different examples. This first one is a straight line 10-year, right? And so that just means it's the same amount each year. On B, they show this double declining balance depreciation, and then you can switch to straight line, right? And so all we're doing is trying to figure out, okay, what is the value of those tax shields, right? And we could calculate what the present value of the tax shield is. And this may sound kind of strange, be building the project, with that in mind. But oftentimes, understanding that could help you understand why you would maybe open up particular locations, right? Because there could be additional tax advantages for doing that. That's where a lot of subsidies that you hear, they come back in the form of tax abatements, right? And so we have to calculate those values. And if you're not going to work necessarily corporate, even working like for municipalities, right? Because they actually get a lot of transfers because they can use their advantaged lending, right, to those public-private partnerships, or the PPP. The how the government will work with private corporations to build things. A lot of times, what they're doing is they're leveraging a lot of that tax status and bond issues, and so we'll calculate that this same way, right? So that's how this plays into it on a corporate side and even on a government side. And so this is just to give you the example back there. So let's see. Air conditioning for a college dorm is 3.2 million to install, and then this is the operating cost. It should last 16 years. Our cost of capital is 8%. We don't pay taxes, right? Because it's a nonprofit. And then what is the annual cost? Right. And so the present value, we're going to pay 3.2 million. We're going to pay 115 million per year, right? And so we would just calculate what is that today, right? For that 16-year cash flow. We're discounting it. Our cost of capital is 8%, so that's what we discounted at, and that tells us what the present value of that is. And then you would just say, okay, well, what is that if we were to put that in an equivalent annual cost? And that's that second equation listed down there, the EAC. You just take the net present value, and then you just divide that. And if you notice, all that is doing is spreading that out over the 16 years, so that we're what the equivalent annual cost. That's not saying it's what we're going to pay each year, because you see we're paying the 115. We're taking that 3.2 million as well and spreading that out over all of the years, what it costs for us to do that, to include our borrowing cost, right? Because we're paying 8% interest, so we have to build that in as well. Here's an example of two different machines. So everything is the same. It's not changing anything about our company. We just have this one that is cheaper, right? But when we're looking at what the lifespan of it's a lot shorter. The one that's a bit more expensive, it's got a little bit of a longer lifespan. And we have additional costs because we have consumption of something. I don't know if it's like a lubricant, or if this is like bearings or what, but there's some sort of cost that we have because we have to maintain the machine. So we're going to buy it and maintain it for a number of years and then replace it. And so the question is, which one, what should you do? So part A says you got to buy one or the other. And then you're going to rent it over the economic life, right? And then it says, if that were the case, what is the annual rental payment you would have to charge? So this gets into something we call transfer pricing. So in one company, part of a company will charge another part of a company something. Like, how do we account for that? We assign a price to move it back and forth. And sometimes that's how corporations will handle their cost centers. They'll just kind of come up with an internal cost for things like administrative services and photocopiers and what have you. And they'll come up with a system, to spread that out to all of the other departments that are using those resources. but they're also a bit communal, right? I mean, legal services are legal services. I'm not going to not advise some marketing team, right? I want to make sure the corporation is doing what they should, right? But that's a way of handling that. And so in this case, it's like, assume we buy it and then we have this internal financing. Um, what would they pay? And so machine A, it would work out to 32,000 a year. Then machine B works out to 30,000 a year. Right. And so machine B is a much better deal because, obviously overall, this is less for us. Now at C, they introduce inflation as well, right? And so they're like, what would happen, if you have that, what would that payment go up to, right? So it's a 4% growth. Yeah, and so there's just that piece showing that little bit of growth. This is another one. Obviously, feel free to just pause it and read over. But you see the spreadsheet showing A and B, those cash flows, what the after tax cash flow is, right? Because there is we're using the depreciation and we have a tax shield associated with that. Okay, so just looking here at A, right? We have our initial payment. I'm trying to get this. So the 2,900 that was your maintenance, and then this is the 40% is your tax rate. See, so taking all of our after-tax cash flows, because these are all the things that we're paying, right? We're depreciating that over, let's see. Okay, so like here's the change in the value in year 2, right? The current resale value at the end of year 2. And so that's where these changes are coming in. It's from this problem. Same thing over here with the using the EAC. And so again, I'm gonna bounce back real quick. All right, sorry, I couldn't get all of that on one slide. The question was a bit too long, but it's just those same equations, but just showing like we're just taking those cash flows. It's just the problems are getting a lot wordier now, and we've got depreciation, we've got taxes that we're paying, but we also could shelter some income from taxes. So there's a salvage value sometimes with these projects, so there's all of these different things that we just incorporate, but it's still the same present value type of calculation. This is an example of, companies will buy assets. They'll have somebody, convince everyone that it's really important, that we have this. So this is an example like an executive jet. And so we've got this thing, but we don't really use it a lot, right? Because it does cost money, right? To use the jet. And so maybe what we should do is let other people do it. So that's what this calculation is about, is saying, okay, what what really is the cost of the jet? You know, what if we start replacing the jet? What would that cost? You know, how much would this save us? You know, and so you know, in this particular case, obviously it's like, yes, this will cause additional wear and tear, but the fact that that jet just sits there and doesn't get used and we still have to pay for it, in this case, we're much better off using it for these other things because of these other savings that it generates. This is another one where we have a conversation around real, nominal, and inflation rate. So obviously, inflation is something that we hear a lot about currently. Real rates are the ones without inflation, right? Like that's the when we talk about um, anytime you hear real, that's what we're saying, and nominal is what we say, like the named. So a nominal rate on a bond is what that stated rate on the bond is, like a 6% bond. And then a nominal return is just this is what the return was. It was 12%. Now it may have been 12% during a time of inflation of 10%, but nominally it was 12%. What we would be concerned with is what was the real return. And so once we have that, then we can discount with that real rate, and that'll tell us the NPV of this investment. Here's another problem where we're examining two different companies, right? And we're going to calculate the NPV of the company, and then we're going to calculate the IRR, right? Remember, the IRR is the interest rate at which the net present value would be equal to 0. Okay, there's another, you know, looking at a comparison between two different projects, right? If you notice in time 0, cash flow at time 0, they're both negative because we're paying for this. Machine A is shorter lived than machine B. Machine B costs more. And then our cost of capital is at 9%. So calculate the NPV, right? And then what would be the equivalent annual cash flow? So we would take the cash flows or the NPV, you know, associated with each of those, and then use that discount rate to calculate what would be the equivalent annual cash flow from that machine, right? Because it's one thing to say, oh, the NPV is 197,000. It's like, okay, but since it's going out over these years, what is that you know, on an annual basis? Okay. And so in this one, we have a machine that currently exists, machine C. And machine C, you know, we can swap it out now for this better machine B, or we can wait until machine C wears out in 5 more years and then swap it out, you know. So machine B is better. We're going to have to buy machine B eventually, but is it better to do it now or to wait 5 years? And so using that 10% discount rate, we just calculate, okay, what's the present value, right? And then you would say, okay, what's this annual cash flow equivalent, right? So taking that net present value, if you notice down there, it's the 202,000, right? That's what these cash flows would be worth, right? And so on an annual rate, that would be $81,000 a year, which is higher than the machine C's 80,000, right? So we don't really care, you know, other than that, you know, If it's worth more than the other thing, you just switch. I know it means we'll have this machine. It's still good. It could still work, but we're not going to use it because the other one's better, right? And sometimes people have a hard time understanding like why you would just stop using it if it isn't, if it's not broken, but there's something better, right? So we have to evaluate it and then swap it out based on that. All right, so that was the last question. If you do have any questions from this, please do not hesitate to shoot me an email, and we can hopefully go through everything so that you understand. Thank you.